Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the complex world of corporate filings. Today we're diving into a report from Veeco Instruments, and spoiler alert, it looks like they just made some debt disappear. How did they do it? That's what we're going to uncover. Veeco Instruments just filed a Form 8K with the SEC. An 8K is a current report companies file to announce major events that shareholders should know about. In this case, Veeco is telling us about a deal they made to get rid of some debt. Before we get into the details, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss these filings and more. Scroll Securities and Kennex Chains. Come and scroll. This filing is a standard Form 8K, meaning Veeco Instruments is required to submit it to the Securities and Exchange Commission to keep investors up to date. The most important date here is May 15, 2025, because that's when the events they are reporting actually happened. Veeco Instruments is the company we're focusing on. They're incorporated in Delaware, which is pretty common for larger companies, and their headquarters is in Plainview, New York. Here they confirm that their common stock is traded on the Nasdaq Global Select Market under the ticker symbol Veeco. This is important because it means the company is publicly traded and subject to certain regulations. Now we get to the meat of the report. Item 3.02 is about unregistered sales of equity securities, which sounds complicated, but it basically means they sold some stock without registering it with the SEC in the usual way. This can be done under certain exemptions, which we'll see in a minute. Veeco got rid of $25 million of debt, specifically convertible notes. These notes are interesting because they can be converted into shares of company stock. Getting rid of these notes can simplify the company's financial structure and remove the potential for future dilution, which is when the value of existing shares decreases because there are more shares available. To get rid of the $25 million in notes, Veeco gave the note holders 1,643,084 shares of their common stock and about $5 to $4 million in cash. So they traded debt for stock and cash. This likely means that Veeco used cash they had on hand and issued new shares, which increases the number of shares outstanding to reduce their debt. The indenture was the original agreement that outlined the terms of the convertible notes. With this exchange, that agreement is now cancelled, freeing Veeco from those obligations. This is the legal reason why they didn't register the sale of these shares with the SEC. Section 4A provides an exemption for private offerings, meaning the sale didn't involve a public offering of securities. Item 701 is about Regulation FD disclosure. Regulation FD is all about making sure that companies share important information with everyone at the same time, not just a select few. In this case, they are referring to a press release regarding the note exchange. The press release is attached as Exhibit 99.1. This is how Veeco made the information about the debt exchange public. Finally, we have Item 9.01, which lists the exhibits included with the report. Exhibit 99.1 is the press release, and Exhibit 104 is the cover page interactive data file. Now let's talk about the implications of all of this. Veeco essentially swapped debt for equity. This could be a smart move if they believe their stock price will increase, as it eliminates the obligation to repay the debt in cash. However, it also dilutes existing shareholders, as there are now more shares outstanding. The fact that they used cash as part of the deal also means they had some available. The company likely felt that reducing their debt was a better use of that cash than other potential investments. Overall, this looks like a fairly routine transaction. Veeco is streamlining its balance sheet by getting rid of convertible debt. The impact on shareholders depends on how the market views this move. If the market sees this as a positive step, the stock price could go up, offsetting the dilution. But if the market is skeptical, the stock price could suffer. It's also worth noting that convertible debt can be a bit of a gamble. If the company does well, the debt can be converted into stock at a favorable price, benefiting the note holders. But if the company struggles, the note holders are still entitled to repayment. By getting rid of this debt, Veeco has reduced some of that uncertainty. Alright, that's our breakdown of Veeco's latest filing. What's your take on this move? Do you think it's a smart decision for the company? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord channel in the description for more in-depth discussions. Thanks for watching, and see you next time.